A war for the future of crypto is being fought on three critical fronts. As CryptoWendy points out, big banks like Morgan Stanley are building exclusive crypto services for the wealthy, while simultaneously fighting to eliminate the stablecoin yields that benefit everyday investors. This corporate push comes at a time when American credit card debt has hit a staggering $1.28 trillion. But this isn't just a corporate battle, it's intensely political. The Coin Bureau channel reveals the crypto industry has amassed a massive $228 million war chest for the 2026 midterm elections, aiming to install pro-crypto lawmakers and pass favorable legislation like the Clarity Act. While this internal power struggle rages, external shocks are hitting the market. Lark Davis highlights how geopolitical crises, like Iran closing the Strait of Hormuz, are causing oil prices to spike and stocks to tumble, putting immense pressure on Bitcoin's price. He notes that Bitcoin needs a decisive close above its 20-day EMA to show any real strength. Yet, amidst all this chaos, Crypto Tips shows us something fascinating. On-chain data proves that while retail panics, whale wallets are quietly accumulating through every dip. So who will win this fight for control? In the latest video from CryptoWendy, she lays out a growing conflict between traditional banks and everyday retail crypto investors. It seems the big banks are experiencing their most significant sell-off since last April, while simultaneously working to control the crypto space. Morgan Stanley, for instance, is setting up a new entity to handle crypto custody, trading, and staking. But here's the catch. It's only for accredited wealthy investors, not for the average person. This move comes as Americans are struggling financially, with household debt delinquency at a 10-year peak and credit card debt hitting a staggering $1.28 trillion. The core of the issue is yield on stablecoins. While you can earn up to 6% on platforms like Kraken, banks want to eliminate that option for retail investors, which is a major reason why a clear crypto market structure is being delayed. They're trying to protect their old way of doing business, where they take your deposits for next to nothing and loan that money out for their own profit. While big players like Ripple and Coinbase are at the table, their interests are more aligned with institutions. The video serves as a wake-up call, urging viewers to reach out to their public representatives and demand fair access to things like stablecoin yields. The video's focus on the tension between traditional banks and retail crypto access is incredibly timely. The narrative that big financial players are carving out the crypto space for themselves isn't just speculation, it's a visible trend. Recent reports confirm a massive push by Wall Street into digital assets, with over 60% of the top 25 U.S. banks now offering or planning Bitcoin-related services, primarily for high-net-worth clients. Morgan Stanley's move to create a digital asset trust and file for multiple spot crypto ETFs is part of a larger institutional stampede. This institutional embrace is happening alongside a contentious legislative battle over market structure, particularly concerning stablecoin yields. The debate highlighted in the video is central to bills like the Clarity Act, where banking lobbyists are pushing hard to limit or ban the kind of yields on stablecoins that threaten their deposit base. This regulatory tug-of-war creates an environment where institutions, who can navigate the complex legal landscape, get a head start, potentially leaving retail participants with a less advantageous playing field once the final rules are set. In the latest video from Coin Bureau channel, the discussion centers on how the crypto industry is gearing up to be a major force in the 2026 U.S. midterm elections. It looks back at the 2024 election, where crypto-funded political action committees, PACs, especially the super PAC Fairshake, played a huge part in politics. Fairshake, backed by giants like Ripple and Coinbase, gathered a massive $227 million, helping to elect pro-crypto candidates and influencing Donald Trump's shift from a crypto skeptic to a supporter. Now, the industry's focus is squarely on 2026, with even more money being raised to support crypto-aligned politicians in key Senate and House races. The primary goal is to pass favorable laws, with the Clarity Act being the main event. This proposed law, which builds on the earlier FIT 21 bill, aims to finally clear up which government agencies oversee crypto. However, it's facing pushback, particularly from the banking sector, which is worried about a provision allowing stablecoins to offer a yield. The video suggests we could see a market rally leading into the midterms as investors hope for clear regulations, but it also points out a big risk. Crypto is becoming a partisan issue. While Republican alignment is strong now, this could create problems down the road when political power inevitably shifts. The video's analysis of the crypto industry's political spending as a prelude to the 2026 midterms is more relevant than ever. The massive war chests it describes are not just theoretical. Recent reports confirm the crypto industry has already committed at least $288 million to the 2026 cycle, with super PACs holding over $221 million in ready-to-deploy cash. This spending is laser-focused on shaping legislation, particularly the Clarity Act, which builds on the foundation of the FIT21 bill. The central conflict highlighted in the video, the battle with the banking industry over stablecoin yields, remains the primary roadblock. While the Trump administration's repeal of the SEC's controversial SAB 121 accounting rule in early 2025 was a significant win, opening the door for banks to custody digital assets, the fight over market structure continues. The video's concern about partisanship is also proving prescient. While the industry's financial muscle is undeniable, its alignment with one party could create long-term instability. The fate of the Clarity Act may hinge on the midterm results, with some analysts suggesting a delay until after the elections is possible. Ultimately, the industry is spending heavily to secure its future, but the outcome will depend on whether it can navigate an increasingly polarized political landscape. In the latest video from Lark Davis channel, things are getting heated as Iran makes a move to close the Straits of Hormuz, a critical channel for 20% of the world's oil supply. This isn't just a small headline, it's causing major waves across global markets. We're seeing the S&P 500 dip in pre-market trading, and Japanese stocks took a massive 7.5% hit. As you'd expect, crude oil prices are shooting up because of the potential supply shock. If this situation drags on, we could see inflation spike again, impacting everything from consumer goods to global trade. Surprisingly, gold, the typical safe haven, is actually down, with investors seemingly rushing for liquidity instead. The video then shifts to the crypto world, pondering if we're in a fast-track bear market for Bitcoin. There's a theory that the bottom might be in, or coming soon, in March 2026, setting up for a new cycle peak around December 2028. A representative from Van Eck also chimes in, suggesting that Bitcoin is in the process of bottoming out right now. On the technical side, the focus is on a key level for Bitcoin. It needs a strong, decisive daily close above the 20-day EMA to show real strength. Without it, the market remains in a shaky position. The discussion also briefly covers a few stocks, noting that Meta is still consolidating in a large pattern and MicroStrategy is looking oversold and potentially ready for a move. The video's focus on the Straits of Hormuz is incredibly timely, as the situation has escalated into a full-blown crisis, effectively halting about a fifth of the world's oil supply. This has sent shockwaves through energy markets, with Brent crude prices surging as traders price in the disruption. While the video noted a surprising dip in gold, the broader market reaction has been a classic flight from risk, with global equities falling. Bitcoin's reaction is particularly interesting and tests its digital gold narrative. Initially, it sold off with other risk assets, dropping below $70,000 as tensions flared. However, it showed remarkable resilience, rebounding quickly, which some analysts attribute to its 24/7 liquidity and institutional buying on dips. This event highlights a maturing crypto market. While not immune to geopolitical shocks, institutional buffers and a growing perception of it as an alternative asset are changing its behavior during crises. The convergence of traditional finance and crypto, with major players like JP Morgan and BlackRock deepening their involvement, suggests that Bitcoin's role in the global financial landscape is becoming more established. In the latest video from the Crypto Tips channel, the discussion centers on how geopolitical tensions, specifically with oil tankers stranded in the Strait of Hormuz, create predictable, albeit seemingly illogical, market behaviors. Rising oil prices are triggering inflation fears, which in turn influences central bank decisions and tightens liquidity. This has a direct impact on risk assets like Bitcoin. We saw gold make a wild $100 swing in just 90 minutes, not because of its core value, but purely due to trader positioning and a strengthening dollar. Bitcoin is caught in these same currents, bouncing around after dipping below $65,000, reflecting widespread uncertainty. The video draws a parallel to the market's reaction to the Russia-Ukraine conflict in 2022, where an initial sharp sell-off was followed by a 40% rally, suggesting that panic selling can burn out quickly. Beyond the immediate headlines, the real story is the fragile structural backdrop of the global economy, particularly the over $35 trillion in U.S. national debt. This massive debt makes the system vulnerable to shocks. While Bitcoin isn't immune to short-term volatility and often gets sold off for liquidity, Its long-term value proposition as a scarce asset with a fixed supply only gets stronger as fiat systems show their cracks. On-chain data reveals that large, whale wallets are actually accumulating Bitcoin during these dips, a classic divergence from retail panic. This suggests that sophisticated investors see opportunity in the uncertainty. The key distinction is that while a crisis can block a shipping lane, it can't disrupt the Bitcoin network, highlighting its unique resilience. The ultimate message is to look beyond the short-term noise and focus on the underlying fundamentals shaping the future. The video's analysis of geopolitical events creating predictable volatility in risk assets remains highly relevant. Recent events in the Middle East continue to influence oil prices and market sentiment, creating headwinds for assets like Bitcoin, which is currently trading in a consolidation range. While the video points to whale accumulation as a bullish sign, recent on-chain data presents a mixed yet compelling picture. According to a March 1, 2026 report, the number of addresses holding over 100 Bitcoin has reached a record high, with major players like BlackRock continuing their accumulation. This suggests that despite retail fear, large entities are strategically positioning for a potential rally in the second half of the year. This divergence between panicked retail sellers and accumulating whales is a classic pattern often seen near market bottoms. At the same time, the macroeconomic picture is complex. The Federal Reserve held interest rates steady in its January 2026 meeting, pausing its recent rate-cutting trend. With inflation remaining sticky, the path for future rate cuts is uncertain, which could keep liquidity tight and pressure on risk assets. However, the institutional adoption narrative continues to strengthen, with projections for 2026 showing deeper integration of digital assets into mainstream finance, which could provide a significant long-term tailwind.
After breaking down four perspectives, a clear picture emerges. The crypto market is fighting a two-front war. Everyone agrees a major conflict is underway between crypto and the traditional banking system over regulation. We're also seeing a clear divergence, with institutions and whales accumulating, while retail investors face uncertainty and restricted access. Where they differ is the primary driver. Is it immediate geopolitical shocks and macro liquidity, or the slower, high-stakes political battle in Washington? The unanswered question is, which front will win out? Your key takeaway: crypto's future is being forged right now, not just on the charts, but in the halls of power.